is our last webcast before the summer break. And in this session, we are focusing on the launch of our Private Markets Governance Forum. We have decided to create this forum because we believe there are a number of very significant changes taking place in private markets at the moment that the industry either isn't aware of or is underestimating the significance of. This is what we'll be getting into today. In brief and broad terms, there is much more detail on all the topics we will be discussing in our publication, The NED, and we will be hosting more of these forums when we return in the early autumn. Today, Simon Osborne, our CEO, and myself will be giving a presentation for approximately 25 minutes, and then there will be a Q&A session, assuming that there are any questions. If you would like to ask a question, please do use the Q&A button at the bottom of your screen. We do aim to finish at around quarter to the hour or slightly before, depending on how many questions we do receive. But I will now hand you over to Simon.
Thank you, Samantha, and welcome to you all. We're delighted that you can join us today. As always, when we host these discussions, we are very pleased to see that we have people following us from a wide variety of different countries. And I'm particularly pleased that we have a number of new people with us today. I don't think have been on one of our webcasts in the past, and that I think particularly applies to a number of people in the US. So you're all very welcome. My name is Simon Osborne. I am the CEO of IFI Global. IFI Global is a research and a media house based in the City of London. We have two monthly publications, a quarterly and a weekly. And one of our monthlies is our governance publication called The NED, which is 15 years old in September. It started out as a publication mainly for independent fund directors in the wake of the big crash at the end of the first decade of this century. And since then, it's expanded in a number of different ways, and our readership is now quite a lot broader. It includes LPs, GPs, lawyers, and service providers, as well as directors. And it focuses on all areas of private market governance, not just the matters necessarily that the board would have to deal with. As Samantha says, we are hosting this webcast today because we think something really significant is going on in private markets at the moment, which a lot of people in the industry are either not aware of, or if they are aware of it, I think they are hugely underestimating its importance and significance. And that is in particular the growth of LP direct investment and its impact on governance oversight and on the industry structure. We'll come on and say something about the industry's structure a little bit later, because we do think what's happening will really have a quite significant effect upon that, as well as upon the governance that has been developed over the last few decades. So the agenda today is we're going to start out giving you a sense of what is happening in terms of the rise of direct investment by LPs who are increasingly going around collective investment structures of different shapes and sizes. And with that, their decline in use of funds, although the use of funds in overall is I'm sure is going to be continuing to grow in the future years and decades ahead. And then we're going to talk about what it means for governance, oversight, and the industry in general. And then we're going to talk about the dangers in the growth of these advisory mandates that are coming thick and fast, co-investments in particular, SPVs, funds of one, etc., and what people aren't really particularly addressing in terms of the problems that are beginning to occur because of this significant growth. and we will give examples of what we mean, of where and why direct LP investment is going wrong, and unless there is more independent oversight of this process, we think more will go wrong in the future. And then finally, we'll finish with a new development at IFI Global and MNED, which we're calling the Private Markets Governance Monitor. So let's start out by giving you a sense of unfortunately, one of the reasons I think the industry is underestimating stroke not understanding what's really going on, because there are not yet anyway a good set of figures that one can track back a few years and see this is what it was in 2021 or 2023 and compare it with today. There isn't that yet. So we are, because the industry loves figures and we don't have that historical data, I think it's one of the reasons why what's happening is being, if not ignored, then underestimated. But Citi, this is a recent survey, I think, Samantha, from just a couple of months ago, Citi's latest global family office survey. It showed that 70% of families are now going direct. Of course, they're also, I'm sure, in many cases using fund structures for many different reasons in different places at different times. But the fact that 70% are coming on to 3/4 of the Citi Global Family Office sample are investing in private markets directly is an indication of the direction of travel that we're talking about here. And Bastia, which I believe is a boutique investment bank, they did some research. This is all very recent studies we're quoting here, just a few months ago as well, just in the private equity space, and 50% of the people they surveyed, the family offices, sorry, I should say, that they surveyed, plan to execute PE deals directly. And the reason they gave for that is because they want the reduced fees they see that they can obtain by going directly, and they do feel they're more in control of the process by doing it as well. So for them, it's a win-win. Bain, again, another very recent survey. This is really interesting. This is sovereign wealth funds, and this is one of the few where you can track back a few years. So in 2023, Bain said that 40% of their sovereign wealth fund sample of investment in private markets was going through co-invest and directly. Today, it's up to 60%. That, if it's the same or similar sample, that's quite a jump in a very relatively short period of time, and is an indication, again, of the same point that we're trying to make here. And I like this quote from Scottish Widows. For those of you outside the UK, Scottish Widows does a lot of retirement work here in the UK, in different shapes and sizes. And they came up with this quote earlier this year: pension funds are increasingly relying on advisory mandates with third-party managers in private markets. Now, to give you a flavour, it's all very well to give you these big, broad brush figures. We thought we would give you a little bit of an illustration of the things that we're coming across on a daily or a weekly basis at IFI Global in terms. This is happening all the time. It's just the most recent examples that we have, just to give you some names behind the figures, which I think in a sense brings it more to life. So Samantha, Samantha picked some of these out. So can I ask you if you could just rattle through the pension fund ones you picked first and why you did that?
Yeah. So I've selected these pension funds just to give you an idea of the kind of direct and co-investment strategies into very specialist areas, which will emphasize the importance of sufficient governance and oversight. So here we have Nest Pension Fund, obviously a UK pension fund. They are the sole investor in 9 pooled investment vehicles. This includes Campbell Global's Forestry Fund of 1. They also have a partnership with Octopus for renewable energy assets as well as a co-invest with HarbourVest. Then, still in the UK, we have West Yorkshire Pension Fund. They are a cornerstone investor in nature specialist asset manager Rebalance Earth, and also their Nature Infrastructure Fund. And I believe, Simon, the fund itself has invested into oyster bed restoration projects, don't they?
Yeah.
which is quite interesting.
Just chipping in there. I mean, we put that example up because there you have a pretty standard British pension fund in West Yorkshire directly investing in oyster beds off the coast of Scotland, which I think is a relatively new thing that wouldn't have been happening until recently. Sorry.
Yeah. Then we have Aware Super, which is obviously an Australian pension fund. Now they have a partnership with Digital Bridge for a data center platform, which obviously gives them indirect ownership to an extent for Vantage Data Centers APAC. Then we have APB, a major Dutch pension fund. They have a bespoke natural capital mandate. So they invest via co-invest, partnership, direct ownership into those kind of assets, which I don't think you would have seen a few years ago. Then we obviously have sovereign wealth funds. You have the Kuwait Investment Authority and Singapore's Temasek. They have partnered to invest in digital infrastructure, which also includes aligned data centers. Then finally, we have Abu Dhabi Sovereign Wealth Fund and GIC. They have entered into a co-investment with private equity firm TPG Rise Climate for the acquisition of Techem, which is obviously real estate, energy, kind of innovation type company. So a lot of interesting activity, I think.
Yeah, and I think the point to emphasize here is this is just a snapshot of what's going on at the moment. If we were here 3 months ago, we would have had another set of examples. And we will be here in 3 months' time, we will have another set of examples. This is just ongoing routine stuff, but the risk of repetition, I want to emphasize, it is increasing, starting with those very large sovereign wealth funds and ABV, the biggest pension fund in Europe, one of the biggest in the world, and it's going further and further down the food chain in every single asset owner LP category. So what does this mean for governance oversight and the industry in general? I think a good place to start is quite a recent survey. This was just a month ago, I think, Samantha, if you correct me if I'm wrong, from MSCI, their private markets report. They came out with the very strong conclusion that the private markets investment industry is at an inflection point for many reasons that we're not going to get into today, way beyond the subject matter that we're discussing today. But it did include some of the themes that we're trying to address this afternoon here. And one of those is that they say that the LPs, the traditional LPs in private markets, increasingly have a desire for more transparency and for more control. And it's worth very much making the point. I think not that long ago, had a drink with somebody who was over in the UK, who's based in Abu Dhabi, and he works for ADIA. And you chat to him and other people like him in similar situation, you will quickly realize these guys in these very large asset owner organizations went to the same universities, the same business schools as the people who work in the portfolio management companies, and they believe, and I'm sure they are, just as bright, just as intelligent, access just as many resources as the portfolio managers, and they feel they want to have more input in the process. That wasn't the case 20, 30 years ago, or even perhaps slightly yet. So that's part of the reason I think we're getting this particular trend. And of course, we have AI now. That's going to have a tremendous impact, one would have thought, upon the whole investing industry in ways that we absolutely won't get into this afternoon, but will be there doubtless more and more in the future. So the other point to make, and this was again touched upon to a small extent in the MSCI report, is the direction of travel for private market funds does not suit large LPs, because what's happening now, and I'm sure many of you are very well aware of this, is that private market funds are increasingly going into this sort of semi-liquid stance with these so-called evergreen funds, as they're called. There's been lots of excitement in places like Ireland and Luxembourg about evergreen funds, other places too. And that may well be the right thing for the promoters of those schemes to do, but it is not the right thing for the traditional large pension funds and sovereign wealth funds, and indeed family offices, some of which we just touched upon, Samantha just touched upon a second ago. And it's therefore a bit of a vicious or a virtuous circle, depending on your perspective on this, because the more the traditional private market managers are losing their traditional large institutional base, so they're going more into this sort of semi-liquid evergreen type world that they're moving into, which means that more and more of their traditional market is going directly and is not going to be going through the traditional fund structures that they may have done 10 or 20 years ago. So we have this, as I say, vicious or virtuous circle going on, depending on your perspective on the industry that's happening at the moment. And I don't think, at the risk of repetition, enough of this is being picked up at the moment. And this has enormous implications for the industry service providers. We use the term here, Mancos, but a lot of people now use the term AFIMs. So for those of you in the States, that's these third-party entities that you have to have in jurisdictions like Ireland and Luxembourg if you're going to have an alternative fund, if it's going to be domiciled in the European Union, where they do the risk oversight in the jurisdiction where the fund is domiciled. The fund directors, of course, enormously lots of implications for them, and indeed for the fund jurisdictions themselves. And just to give you a sense of the importance of the private markets for fund jurisdictions, a couple of figures to quote to you this afternoon. In Luxembourg, the largest overall market, if you include public funds as well, nearly half the funds launched in Luxembourg and last year, I think, are in the private equity, private debt space, and that's from Monterey Insight. Unregulated funds in Luxembourg overall is now 24% of their $9 trillion total. Cayman, private market registrations are up by 43% since 2020, and they are about over 18,000 out of a total of 32,000 funds registered in Cayman. These are obviously enormous. I mean, no one's saying, and so we are certainly not saying, the private markets fund industry is going away. Of course, it's going to be around for years and decades to come. But what we are saying is the high watermark of institutional asset owner LP investment from family offices, perhaps also endowments, certainly pension funds, sovereign wealth funds. That is over. The high watermark has come and gone, and that market is in decline in terms of its investment into collective investment schemes of one form or of another. I was having a chat with someone the other day. We were discussing this point about what's going on, and we sort of had the analogy of in the old days you would have we're talking about transport. You have a plane where you have your first class passengers, business class and economy passengers, but the plane was flown by the same pilot, and that would be some kind of a private markets fund structure. Increasingly, some of those people that would have been in first class are now flying in private jets. So the first class cabin is going, and it's becoming more like a Virgin flight where you just have business class and economy rather than the first class, if that's the case in Virgin these days. I can't quite remember. I certainly it's been a long time since I've been at the front of the bus in Virgin, so I can't say whether that's the case anymore. But the analogy is not a bad one. But of course, it's the same. If you call it the portfolio manager, it's the same portfolio management company in the cockpit, but the vehicles that are being used are different. That analogy, I think, probably needs to be perfected a bit before I use it again in the future. But as I said, this has enormous implications for the industry service providers, Mancos, fund directors, and its jurisdictions. It also has, and this is what we really want to focus on for a few minutes now, implications for independent oversight and the monitoring and expertise. And we're now going to get into some failures we think partly have arisen because of these changes in structures that are going on. So Samantha again picked some of these out. These are again just recent ones. We were here 3 months ago, or when we're back in 3 months, we will have another set. So if you could just rattle through, Samantha, why you picked some of these private market failures that have, this is direct of different in different ways direct in real estate. Do you want to rattle through some or all of those?
Yeah. So obviously at the start we have BVK, which is one of Germany's largest pension funds. They have a series of failed real estate investments, which includes a direct investment with a disgraced property developer called Michael Schroe and Deutsche Finance America. Sticking with Germany, we've got Hessen Lawyers, which is a relatively smaller pension fund, but they again experience significant losses, I think totaling 58 million euros just on one investment with Transamerica Pyramid, which was tied to Deutsche Finance Group as well. Then we have the Malawi's pension fund. Now, this is quite a juicy failure, but I won't go into too much detail. It is in the June issue of the NED. They did operate without a board for a significant period of time and failed to seek independent valuation for direct real estate investments that they went into, which skyrocketed before they acquired it. Then you got Electa, again, a series of direct real estate investment losses, including a joint venture as well. Then you've got Signa Holdings, which is obviously a very, I think it's Austria's most significant real estate failure to date. A lot of family offices and sovereign wealth funds have been tied up in this and have experienced significant losses. And yeah, South African pension fund, I won't go into it now, but it is mentioned in the NED as well.
And just quickly to round this off, and more failures in certainly in the sustainable space. We probably first got into this by work. One of our other publications is called Sustainable Investment Intelligence, and we have seen a lot of direct investment from asset owners into the sustainable sectors and renewables, where we first became really aware of what's going on. So this is something we just picked out.
Yeah. So Visa B is a very small German dentist association's pension funds. They had assets of 2.2 billion euros. They've wiped out 1.1 billion due to a series of private market failed investments, which include direct investments into a German shrimp farm, Californian recycling firm, co-investments into luxury real estate in Europe as well. They are currently suing their auditor, their advisor, 9 former and current board members as well. So it's a significant governance failure for that one. Then you've got Michigan Employees Retirement System. This is in relation to a direct investment into a Hawaiian coffee farm. It had failed. It's an issue of failing to monitor the asset post-investment. You know, you still have a fiduciary obligation, and they just didn't look at it. They didn't know what they were investing in, that kind of thing. And then we've got renewables. Again, Michigan Employees Retirement System, this time in relation to a failure to spot conflict of interest with its co-investment with Verdant. Yes, they are suing that asset manager. Then you have AP funds, AP 1, 2, 3, and 4. They entered into they established a co-investment vehicle which lacked independent governance, any kind of risk management whatsoever. And now you're obviously invested into Northvolt, which failed. And then finally, we have Thurrock Pension Fund, which Simon, you're able to give more detail on, but it was a direct investment into solar assets.
Yeah, very quickly, I'd love to go into this. Is one I do know very well. And sadly, a lot of the time when we hear stories about what's going on, we can't publish anything about it because it's rumor and it never gets into the media. But you just have to trust us. There is quite a lot of stuff that's swept under the carpet. It's clearly neither in the asset owner's interest nor in the investment manager's interest to have this get out. So generally speaking, it doesn't. Occasionally, though, things do get out, and we know the person that unearthed the pension fund advisor who actually unearthed the problem at Thurrock, and this was a really big drama that got into not just the Financial Times, it even got into sort of a mass circulating mid-range newspaper here in the UK called the Daily Mail. It was a big drama, and Thurrock Pension Fund lost an awful lot of money investing in solar farms. And this, in one quick sentence, outrageous lack of governance oversight on what was going on was the simple problem. If it had been a kind of fund structure with a proper board, I'm pretty confident, unless the board was completely asleep, that would not have happened. But because of what they were doing and the way they were doing it, and sadly, lots of retirees in Thurrock, which is part of Essex and not a million miles from where Samantha is at the moment, they wouldn't have lost out in the way that they did. So quickly, another very common way of, if there's two forms of, if you look at the growth in direct investing, there's two forms. There's the co-investment and then there's the advisory mandates. So in the co-investment world, it's very, very popular, particularly in sustainable investing and in other areas too. It obviously originally comes from the private equity part of the business, which has been adopted in other areas over the last few years. The point we want to make quickly is that co-investments really do require more commitment, monitoring skill, and experience than many LPs just have available, including their advisors. They just don't have the bandwidth or the experience to make that kind of commitment. They think it all sounds great when they go into it to begin with, but as Samantha was saying earlier, often it's the ongoing monitoring. It's not just the initial due diligence of the original investment, which by and large everyone seems to do to a satisfactory level. It's the ongoing monitoring, and when it's direct or through a co-investment, that's the bit that often drops off. And that's where so many of the failures we've just touched upon and others we haven't touched upon but we're aware of, that's the reason for those. There's two particular co-investment risks we should quickly mention. Of course, the LP is more exposed to individual company failings through a co-invest than they would be through a fund, which so far removed, it's not going to be a problem for them. So Samantha was mentioning Hawaii coffee farms and goodness knows what else, and shrimp farms and other things, which look good on the LPs or the pension funds annual report when you have a nice picture of a coffee farm in Hawaii as a front cover or whatever it may be. But when you don't do the due diligence and things change at the coffee farm or the shrimp farm or whatever it may be, there can be problems. The second thing to mention is that there are often, very often, not always, but very often, a lot of hidden fees involved in co-investing, and they're called quote unquote monitoring fees. So the asset manager it's still almost certainly going to be less expensive than going through traditional private fund, but it's not quite as substantial a difference as the LP often thinks once they start getting hit with ongoing monitoring fees. So lessons to be learned. LP direct exposure to assets is happening increasingly, as we're saying, but it's not always taking place. And this particularly applies in sustainability and in renewables. Renewables is incredibly complex, particularly offshore wind farms. These are very complex, sometimes highly leveraged structures, and LPs are directly investing in them in ways that neither they nor their advisors perhaps fully understand. And you need people often even with engineering level degrees or understanding to really grasp what's going on, and they don't often have that, including the advisors. Structuring, this is a slightly separate point from other ones we're making this afternoon. We thought it was worth mentioning in passing, particularly the MFS disaster earlier on this year. And Samantha, do you want to quickly say something about that? The structuring complexity, which isn't the same thing as going direct, but it can be a problem too. Do you want to say something about that?
Yeah, obviously there was a fraud, and they did use warehouses, which isn't abnormal for private credit at all. But the deliberate deception of the rest of the chain was an issue. So it meant that everyone within it was relying on an independent verification structure that was never wholly independent of MFS, which obviously allowed the double pledging to occur, and investors lose out on what, billions. So you do have very transparent structures around. But as Unicus Investor said, there were enough red flags within public disclosures which warranted just digging a little bit further, and the whole chain would have been uncovered.
Right, thank you. And the last point on this slide, I think we've made already a few times. It's really often it's the oversight obligations and monitoring that should not be forgotten in advisory mandates, co-investment, and other direct investments, which we do think and believe are often being forgotten or neglected. Which brings us very neatly to our private markets governance monitor. This is something the NED is launching. You'll hear much more about this in the autumn. It includes a governance checklist for LPs and their advisors for all potential fund structures, not just the directs, but the fund structures. And there are many different types of fund structures. We haven't touched upon those today, but there are obviously, and they're actually proliferating and getting more complex, which isn't a good thing, we don't think, on the whole. There's the co-invests we have been talking about, the advisory mandate. So we are developing a checklist for our subscribers, and contact us if we're looking now to get input for that, if you want to get involved in that in some way. Another thing that Private Markets Governance Monitor is going to be doing is looking, and there are plenty of pros, of course, in going down the co-investment route or taking an advisory mandate, and so on and so forth. But we have absolutely no skin in the game, so we can say what we think are the pros and the cons, and we're not trying to sell anything to anybody in that regard. So we can give you the yin and the yang. And also to make the same point again about we think there should be more oversight. There isn't an entity in the business. If it's not independent directors, it is these things for those of you in the States that may not be so familiar with Europe, these things called MANCos, management, which is an abbreviation for management companies. There's a lot of third-party management companies in Ireland and Luxembourg, and indeed there are others in other places as well, in London and other places, sometimes called AFIMs as well. And these would be entities one would have thought for not an outrageous sum of money could come in and do that ongoing monitoring, because they have well-paid risk officers, at least two in most of these MANCos, who could sit and watch and monitor what's going on in some of the outside, and they have no other no other responsibility in the investment process. They could be the ones who play a good supervisory oversight role, and that's a place that I think some of them should be evolving into outside their traditional business. So that's really all we wanted to say. I'm looking at the time. I've already gone past 3:30, so we have time, I think, for a few questions. Let's just see whether there are any. And Samantha, so over to you. Did we get anybody wanting to ask any questions?
So the first question is, why do you say that the growth of LP direct investment in private markets has been underestimated? And do you have any stats on this?
Why has it been underestimated? I think the reason it's been underestimated is because in the second part of that question, it sort of gives the answer, because there haven't been enough stats on it. There just hasn't been that same monitoring. I quoted Monterey, who does a lot of work in fund stats in different fund jurisdictions, but there hasn't been anyone doing it. Therefore, I think it's been happening it's been going beneath the radar screen of a lot of the people that comment on this business. But it is going. So that's the reason. I think people love numbers. They want it until they have a number. They don't feel it's necessarily something they can latch onto and take as seriously as they would otherwise. And that's probably why it's not been taken as seriously as it probably should be, I would say. Hopefully we at IFI Global, in terms of what we're doing, certainly in the renewable and in the sustainable sectors, we've been doing this now for long enough, we can come up with something for that, but that wouldn't necessarily be the same as private equity or any of the other areas, but we could probably do it in those areas in the future.
Mm-hmm. Yeah. So the next question is, can you expand on what you mean by advice on finding independent oversight outside fund structures?
The only expand in terms of what I said about having these entities called management companies, maybe independent director firms, and there are a number in any jurisdiction in Cayman, in Luxembourg, in Ireland, and Jersey, or wherever there are independent third-party governance firms. They would be obvious candidates to do this too. Some of them probably are already doing it more than we're aware of. They would be that would be a good growth area of their business, because it's very much the same kind of job as being on the board of a fund and doing that oversight job as you would do on a traditional fund. But I think there should be somebody who's not associated either with the advisor firm to the LP, or to the LP, or to the portfolio management company, that is there looking at what's going on and from his or her independent perspective in a way that really is not happening today. Obviously, in a lot of direct investing, it's for the control, and they think they have the control, they can do it themselves. But as we've been quoting today, there are plenty of examples where it does go wrong, where somebody might pick up on that through their overall independent monitoring.
Yeah, I'll probably also stress that, there might, when you invest in kind of specialist areas like natural capital, you probably might want specialist due diligence, and also counsel as well to structure it and understand and fully get into the allocation policy itself and know your rights in the investment. But yeah,
absolutely.
That's all the questions.
That's probably, I see it's coming up to 20 to the hour. That probably would be as good a point to end on, but we will be carrying on very much, because we think this is a hugely important subject, and as I said many times already, underestimated, if not ignored, by a lot of people in the industry, and we'll be covering it in a lot of different ways from now on in the NED and in other parts of what we do in the near future. So hopefully all of you out there have a very good summer. Feels like if you're in the UK, summer's been going on for months already, which is unusual for us here, who's had a continuous heat wave forever. But have a very good rest of the summer to everybody, and hopefully see you again in the early autumn. But as Samantha said, all that we've been talking about is in much more detail in the NED and in our other publications as well. So have a good rest of the day, week, month, and see you again, I hope. Bye-bye, everybody.
Bye-bye.